What's going on, Investor Family? I'm Stock Market Jay, and we talking about the federal fund rate today. All right, guys. So what people got to understand is the Fed right now is about to actually pivot. Right, they're about to go from increasing interest rates or having a high interest rate, right, to now decreasing interest rates. So essentially, it's time to go ahead and lower interest rates, stimulate the economy. Now, this has a dual impact on the consumer and the investor alike. So, the federal funds rate is the interest rate at which banks lend and borrow excess reserves to each other overnight. The Federal Open Market Committee, the policy-making body of the Federal Reserve System, sets the target rate range for the federal funds rate for 8 times a year as a part of the monetary policy. The rate is a key tool in U.S. monetary policy that affects financial stability and economic growth by influencing overall interest rates. Now, why is this important? Because this creates booms and busts in the economy. This is why you have uptrends and downtrends, because the Federal Reserve is continuously manipulating monetary flow, the flow of money, right? Essentially by pulling liquidity out of the economy when they want and introducing liquidity back into it. This entices booms and busts. So the federal funds rate affects a wide range of market interest rates, including those on loans, credit cards, bank accounts, CDs, and savings accounts. So when the federal funds rate, it can impact the cost of economic activity, right, which can help regulate growth and control inflation. Now, here's the thing. Does it control inflation? Yes. But inflation is only an issue because the Federal Reserve is printing money or lending money hand over fist, or they're enticing consumer spending by making money more accessible and making money cheaper, making debt cheaper, which is inflationary in nature, right? They control the inflation. Here's the thing, they're controlling economic growth as well. The economy can really regulate itself, business regulates itself, but when you have a governing body regulating those things, instead of just allowing it to maneuver and operate how it should be done, this causes moments in history where you have high interest rates. This causes moments in history where you have high inflation, and also when you have low interest rates and low inflation. So this can impact the consumer by way of, when interest rates go down by 25 basis points in September, here's what's going to happen. Because the Fed funds rate is between 5.25 right now and 5.5%, right? When they lower those interest rates, now interest rates on those CDs, those certificates of deposit, are going to come down. The interest on high yield savings accounts and those online accounts that you've been enjoying those high APYs of are going to come down. The interest rate on bonds, notes, bills, and of course other, I'm going to say, debt market accounts are going to start to come down as well. And of course you're going to see those variable APYs or APRs, I should say, on those lending products, those loans, credit cards, and things like that. They're going to come down slowly. It's a lagging effect. It takes time. So just like how the interest rate, it took a year roughly to get interest rates to where it is, a year to a year and a half. They stayed there for about a year, and then now they're coming down. So it'll take some time for interest rates to come down. It'll have to take a little while for it to stabilize the economy, so things can begin to, the fluctuation, the up and down movement and momentum can stabilize. Now you'll see interest rates begin to drop on these credit products and these products where you can make an APY on, gradually and slowly over time. But here's the thing, you still have time to position yourself. You still have time to lock in some of those higher APYs, let's say on a shorter term bond, or on a note, which or bills which happen to be shorter duration. You can buy T-bills at 4-week durations and things like that, right? So you have to understand that during this economic cycle, because the economy is about to shift, it's about to pivot, and the cycle is about to rotate, it's about to shift, and it's about to change. You as the investor have to be prepared, right? Because now you're going to see automotives and those more cyclical businesses begin to take off, right? They're going to begin to they're going to begin to explode and it going into a cycle of expansion because there's more liquidity. People get to be less discretionary with their dollar. Their discretionary dollar can go further, so they don't have to, hey, what should I do this month to enjoy a good time out with the family? Should it be this or should it be this? Well, now, since things are cheaper, since the money supply is greater, you can do more and you can have more and you can get more. As an investor, stocks tend to do very well in a low interest rate environment, right? Because it's more liquidity. It means it's more investing power. You have more investing dollars. Debt is cheaper. People use debt to invest. They use debt to build. Businesses tend to fare well during these economic times. Right now, you'll start to see a shift go from the bond market from the debt in the bond market over, and money will fluctuate into the stock market, right? And then of course in the interim though, you're still going to see an influx into the debt markets, into the money market accounts, into the high yield accounts, into the CDs and things like that, only because people want to take advantage of the higher interest rates that you can get from the fixed income asset class, because it's going to provide you that safety, right? That safety net. There's no turbulence in the debt market, right? Unless it's like, some less than investment grade bonds. There's no turbulence in a high yield savings. There's no turbulence in a CD. There's no turbulence in an investment grade bond or an investment grade corporate bond or a double A, triple A government bond, right? There's no turbulence in that. So it's safer. So you will see an influx of money going into the debt markets because they want to lock away that interest rate and make sure that ensure that their principal is protected. All right, investing family. Peace.